Während viele Anleger westeuropäische Märkte bevorzugen, fristet Osteuropa ein Nischendasein. Zu Unrecht, wie ein Blick auf die Fundamentaldaten zeigt. Beispielsweise hat die polnische Wirtschaft Deutschland in den letzten Jahrzehnten deutlich überflügelt. Darüber hinaus zählt osteuropäische Aktien zu den weltweit niedrigsten Bewertungen. Der Internationale Währungsfonds prognostiziert für Osteuropa in Zukunft nach wie vor ein deutlich höheres Wachstum als für Osteuropa. Im Interview erläutert Mehis Raud, Fondsmanager und Partner bei Trigon Asset Management, die Vorteile einer Investition in osteuropäische Aktien. Er seit über 20 Jahren bei Trigon Asset Management und mit seiner Strategie hat er die Benchmark deutlich über diese Zeit geschlagen. Bleiben Sie dran, seien Sie gespannt. Mehis, last year was a great year for Eastern Europe. What was going on the stock market in the East? Why such a high return?
Thank you, Thomas, for that question. Indeed, I mean, last year was the best year in my career. I've been 21 years focusing on Eastern European markets. And in 23, we managed to offer 46% euro-based performance to our clients. Also, region, of course, did very well. So region was up 40%. But you have to put it a bit into the context of 22 as well, because 22, when the war started, then Eastern European markets actually performed quite badly. So our region was down like 20% over the year. We actually managed to do much better also in 22. So we fell only 6% in the previous year. And what we did, I think, right was that at the end of 22, in autumn, when the market was bottoming back then we managed to shift quite a big part of portfolio to more cyclical names and to those names that benefited last year. So we managed to be in line or even slightly better than the market in 23. And it was also driven by corporate earnings because in 23, actually, Eastern European companies offered the highest ever net earnings in history, driven by the financials and oil and gas companies mainly.
You are direct contact with the companies. What is the situation of the companies now?
Indeed, I mean, we do each year almost 200 plus company visits. So this is a core of our kind of process. And as you can see, I mean, despite of this huge rally in the markets, the valuations still remain relatively attractive in absolute terms, but also in compared to their country's own 10-year histories. And that's mainly driven by, as I said, the banking sector, which is benefiting still from a high interest rate environment and abundant liquidity. So deposit rates are still lowish, while they generate income on the NII side and fee income side. Oil and gas sector is still benefiting from very high oil price and refining margins. Maybe if you talk, for example, about utilities, then this segment is somewhat burdened still from the extraordinary windfall taxes in some cases, some countries. And also in terms of industrials and retail companies, you need to be a bit selective. There are some companies which last year already started to benefit from lower energy prices, lower cost of goods sold, while there are still some industrial companies which are suffering from the lowish demand. In 2024, that should potentially change with a potentially higher real salary growth for people. Maybe also one general factor in the region is that the balance sheets are in very good shape. For example, in our fund, the average net debt to EBITDA of non-banks is 0.6, while many non-banks have actually net cash on the balance sheet. So they have even been benefiting from the higher interest rate environment while earning more on deposits. And strong balance sheets combined with good profitability, that also allows them to pay very generous dividends. So again, for example, in our Trigon Europe fund, average weighted dividend yield for last year's earnings will be around 6.5%, which will be paid out now in this spring and coming month, basically.
Do you have a specific story for the past years?
Sure. One of the names which maybe explains quite nicely our approach is a Romanian-based small cap company called Sfera Financial Group, which you can also see the investment case on the screen. So basically, the company was brought to market in 2017 with great this kind of hopes in terms of the revenue and then profits growth for coming years. Back then, we liked a lot the business model, but for us it was a bit too pricey. But they were basically asking sector average ratios, which were like 12 to 13 times EV/EBITDA, close to 20 times P, on assumptions that in Romania the outdoor dining will be growing very very fast for in coming years after the IPO. As actually the company did not deliver to the expectations which they promised at IPO times, then the stock price started to fall. So from 44 RONs per share in 2017, it basically fell down to I think the bottom might have been like 10, so roughly like almost 80% reduction from the IPO levels or from the top levels. And of course, I mean, meanwhile, there was also COVID, when the restaurants had to be shut down. Then after COVID, there was a very sharp increase in costs, in chicken prices, also employee costs went up significantly. So then the margin became under pressure. But this was a time basically when we started to look at the company much more deeply. As we liked the long-term this kind of growth potential of the company, and using kind of a historical average or sector average margins, we understood that the company was back then trading at 3.5 times EV/EBITDA, like 5-6 times P ratio if things would normalize. And during this 2021-22 periods, we basically accumulated almost 6.5% of the company, which is actually a bit more, actually much more than we usually do. We usually don't go above 3%, but as it was such a small cap company, then this time we made exception. Also, balance sheet strength. The company had basically no debt, excluding the leasing payments or leasing liabilities. And since then, when let's say especially last year, when the chicken prices started to go down, in general cost pressure started to ease, and the company managed to generate more and more revenue. Then now the company has basically tripled since our acquisition price. So this is how we usually approach the companies and kind of small mid cap names in different markets, and how we create value for our investors.
What is the situation in general in Eastern Europe? We hardly see any news except that inflation was significantly higher than here.
True, yeah, I think that sense Eastern Europe was one of the worst examples globally back then after the COVID years. In some markets, like also in Estonia, where I'm from, but also in Hungary, I think inflation peaked at around 25-26% year-on-year levels. Since then, things have actually improved quite a lot. So in the last couple of months, headline inflation levels have come down significantly. So now we're talking about 2% levels, 2 to 3.5% levels in different markets. So that means that central banks, which actually were extremely prudent when inflation went up, Eastern European central banks were one of the first to start hiking rates. Now they also have started to cut rates earlier than, let's say, US or Western European or EU have done. But the rates are still, in real terms, they're still positive rates. So there is, for next 6 to 12 months, I would expect that rates would be cut further. Therefore, potentially increasing this kind of domestic demand-driven growth story in the region. And as you can also see from the graph, then last year, quite many core Central Eastern European countries were in recession, like Poland, Hungary, Czech Republic. Then this year, 2024, there should be it's kind of recovering to a more normal potential growth rate. It's said that it's kind of expected potential growth rate should be between 2 to 4% in Eastern Europe over the next decade. And that should be roughly 2 to 3 times faster, depending on the country now, compared to the Western European markets. Of course, we also have some investments in Kazakhstan and Turkey, which tend to be with a bit different dynamics, especially Turkey with its very high inflation rate. But even in Turkey, with Erdogan allowing the central bank to become more orthodox, we see some potential for normalization in coming years.
How do you see the potential for the future in this region?
Longer run, as I partially mentioned as well, that the potential growth rate is considered to be between 2 to 4%, maybe slightly more in Kazakhstan and Turkey, where we also operate. And it will be again mainly driven by, of course, historical kind of macro drivers, which Western Europe has been strong and competitive, like car manufacturing, machinery, equipment manufacturing, but also in some regions like Turkey, Croatia, Greece, driven by strong tourism, especially in the short term. But looking into the next 5 to 10 years, I think more and more actually the growth will be driven by also digital economy. And this is something that Eastern Europe has become like a back office in terms of IT service providing for many global companies, but also there are more and more proprietary software being developed by Eastern European companies. Also, there is a quite strong startup culture in Eastern Europe. So it's roughly 1/3 of all the startups from Europe are actually being originated from Eastern Europe. And Estonia, in that sense, also looks very good because in terms of unicorns per capita, Estonia actually stands as the first globally.
After the good returns, do you see that interest among investors has increased?
I would say so. Maybe putting your question to in perspective, then and giving some more this kind of color that active Eastern European managers used to have around 10 billion euros under management in good days. It's kind of and after this Russia-Ukraine war, and after the Russian assets were written off for many of these kind of Eastern European wider players, which had Russia included in their fund, then this amount fell to 1 billion. So from 10 billion to 1 billion drop in terms of actively managed funds. Now the latest numbers are showing that this number from 1 has now grown to 2 billion. So there clearly has been some recovery, both helped by mainly, of course, performance, but also helped by some inflows, which I've noticed. We're not clearly following this kind of gem fund allocation or hedge fund allocation, but it seems that at least in regards to recent IPOs or accelerated book buildings, there seems to be also some more traction, some new money coming from either it's kind of Western European funds or some global emerging markets funds as well.
Let's move on the fund you are responsible for. What is the secret of your significant outperformance?
There's no this kind of special secret that we basically started to run this strategy since 2009 when I took over the fund, and we actually haven't had to change our investment philosophy or the main investment thesis throughout this period. I think the core for us is to understand the companies that where we invest in, how this company is positioned, how this company generates cash flows, whether they are willing to share these cash flows with minority shareholders like us. And then we also, of course, want to understand that if we see a good value in the market, that why this company is cheap today, why this should change in coming I don't know, 12 to 24 months. So what will be the trigger to release the value in this company? And I think this is where we're putting a lot of work. We're also, of course, also doing quite many company visits. So we do travel a lot in the region. We meet management teams to understand the models, to understand how they think and what's the kind of outlook for the sector or the company specifically. And then maybe finally is that I think we have the courage to be different compared to the market. So quite often in either crisis times or when there are some cyclical, this kind of downturns, then we tend to be different and take the view and then buy in when others are selling or when sell side analysts do not like the company. So I think these are the basic main points for our success.
So okay, thank you, Mehis, for your time and the detailed insight into Eastern Europe. Thank you for your time.
Thank you, Thomas.
Das war das Interview zu osteuropäischen Aktien und welches Potenzial darin besteht. Vielen Dank, dass Sie sich die Zeit genommen haben, und wenn Sie auf dem Laufenden gehalten werden wollen, abonnieren Sie einfach den H1 Akademie-Kanal, damit Sie zeitnah die neu erschienenen Videos bekommen. Dankeschön und bis bald. Tschüss, Ihr Thomas Polach.